Let's think about pooled investments for a few minutes, and there's a bunch of different types of these. So pooled investments, we can work with an open-end mutual fund, right? So this is, when you think of a mutual fund, this is probably what you're thinking of. So you can purchase or redeem securities at the NAV, right? So NAV is simply net asset value, which is just the value of all the securities they're holding less any debt, divided by the number of shares outstanding. So you can purchase or redeem the securities at the NAV anytime you want. The number of shares outstanding changes with purchases and redemptions. So if somebody comes in and says, okay, I want to redeem my one share here, it's worth $150. Well, they take $150 out of the fund, and they also take one share less outstanding, right? So the net asset value per share doesn't change at the instant that somebody removes their funds. So the 157 comes out of the numerator and 1 comes out of the denominator. So the net asset you can redeem at the net asset value anytime you want. There is a fee for ongoing management services, and the fees vary wildly. So from 7 basis points to 3.5%, something like that. We also have loads. The load is an upfront charge or a redemption charge. So you give them $100, they take $5 and invest $95 for you. Okay, that would be an upfront charge or a redemption charge. You put in some money, it grew to $100. You go to take it out, and they send you $95 and call it good. So they could have upfront charges, redemption charges, or both. They are also no-load funds. I'm personally an advocate of these. Anyway, no-load funds don't have either type, upfront or redemption charge, although they will still have some management fees. So there are costs in the simplest world. There are costs associated with managing a portfolio. It's passive, completely passive, ultimately passive. Well, they still have to see when the universe changes. So if it's managed the S&P, occasionally that changes. They have to send out statements. They have to pay security and compliance, all those types of things. So you're always going to have at least some ongoing fees, management fees associated with a mutual fund. So that's going to be an open-ended fund. And the idea is you can always buy or sell, that is redeem or purchase more of the fund at its net asset value. Contrast that with a closed-end mutual fund, and this is where there's a fixed number of shares. So it's issued like an IPO. So we're going to issue so many shares of this thing, and then we're going to buy some portfolio of securities, and we can calculate a net asset value, but it's not necessarily going to trade at the NAV, and we'll talk about why in just a second. So these closed-end shares trade like stock. So there's a commission, you have to pay a bid-ask spread, you can margin them in some cases, you can short them in some cases. There is a fee for ongoing management, so you have to pay that each year. It'll come out of the corpus. And market prices for these differ from the NAV. So if you think of saying, okay, net asset value, well, I guess I had to write the right thing. Net asset value per share is equal to $100. Well, this thing could sell for $110 or it could sell for $90. And the notion here is there's no new shares created, but there is a difference in the demand for whatever this closed-end fund is doing. So let's just say this is a closed-end fund that is devoted to emerging market securities. A pretty broad category, but just as an example. Well, in times when people really want emerging market exposure, they may bid the price up above the net asset value. And in times when they don't want emerging market exposure, well, there may be people selling those shares and they may drop all the way down to 90. So the market price can and does differ from the net asset value. And this would be something I would pay attention to because we're going to talk about that again in just a moment when we talk about ETFs. So the one advantage of the closed-end funds is that they don't need to hold cash because they don't have to meet the redemptions of people who come and say, hey, I want to liquidate my mutual fund. You can get your money out of a closed-end fund, but that's because you sell the share to somebody else. So it's like a share of stock that you sell. So you own stock in this portfolio of stocks maybe, right? So anyway, on the closed-end funds, I think there's fewer of these, less money under management, and probably going to decrease more rapidly than open-ended funds. But they're both going to decrease in my mind because of the ETFs that we'll talk about in just a couple of minutes. So the types of mutual funds by investment objective. Well, there's as many types of objectives as there are objectives to be had. So money market mutual funds, these are the funds that invest in very short-term, high-quality debt securities. So very, very low risk and, of course, very, very low return. You can have bond funds that do anything, right? So, high-yield bond funds or junk bonds, global, worldwide, domestic, government, corporate, long-term, short-term, tax-exempt, long duration, short duration, left-handed managers, whatever it happens to be. So lots of different mutual funds out there that deal with fixed income securities. So you can find one that does whatever it is you're looking for. Stock funds would be the same way. So you can have, broad universes or narrow universes. It could be active or passively managed. You can have it for, different sectors. You can have it for over size, value ranges. You can have it for countries. Whatever it is you're looking for, you can find a mutual fund, either an equity fund. You can certainly find an equity fund, probably find a bond fund that would give you exposure there. And then there's also balanced funds, and these are ones that do more than one asset class. So a balanced fund would be something like, we're going to manage for 70% equity and 30% debt, or a life cycle funds. They'll keep you in a asset in an allocation range appropriate to your age. If you think there is an appropriate allocation life cycle, those types of things. So those balanced funds are going to have some assets in one asset class and some assets from another asset class typically, and they're going to try to trade those off. So what about other pooled investments? Well, this is the ETFs that I alluded to earlier. So I think this is a relatively simple view of ETFs, but nonetheless, it's okay for an introduction. The ETFs are typically index funds. So we're going to establish a portfolio, and then we're going to have very low turnover in the portfolio. So we're going to buy these 100 securities, and that's going to be what is in that fund for pretty much its entire existence, which is technically forever. So these are just funds, like a closed-end mutual fund, okay, where the shares trade on an exchange. Right? And the underlying portfolio is an index. So it could be Indonesia index, it could be Japan, it could be the Pacific Rim, it could be US, it could be a technology index, it could be a value index, it could be anything else. So they trade like shares of a closed-end fund. You can short them, you can margin them. The dividends are typically paid out. And they may have tax advantages over the open-end index funds just because of the way they buy and sell. So even though they may both have low turnover, well, the fact that you can get in and out of this as a security rather than having to pay the taxes on the underlying components would make the tax implications different and better in many countries. Now, the thing that I want you to focus on here is this next to the bottom bullet point, and that is this idea of in-kind purchases and redemptions to keep the market price close to NAV. So remember, if the net asset value is 100, was the example we used for closed-end funds, and we said, oh, well, this may go up to 110 and down to 90, and that would be a really big deviation. But nonetheless, when we talk about an exchange-traded fund, it can trade at a value other than its NAV. But it's going to be close to its NAV, and here's the reason. So if this is an index fund, whoever starts this index fund says we're going to issue these shares, we're going to buy this portfolio, and the portfolio is a list of securities, right? And each of those securities has a value associated with it. I own this many shares, they're worth $10 a share, and you can add it all up. Well, if it ever gets to the point where this was trading at $120, right? Well, then what we could do is buy a share, and say, okay, I want the securities instead of the share, and we could take the securities out and we could sell them for $120. So we could buy them for $100 and sell them for $120. We'd have the transactions cost. That would be an in-kind redemption. So instead of saying, I'm going to give you back my share, I don't want you to give me money, I want you to give me the actual underlying shares. And if it got down to $80, then we could do the opposite, right? So we could have a purchase, which means we could go out and buy the securities, and I may have gotten those backwards. Redemption, yeah, I've told the story backwards. Anyway, the point is we could go out and buy $80 worth of securities, create a share, and then sell that for $100. So the fact that we can arbitrage away differences, for these in-kind, using these in-kind purchases and redemptions, keep this market price really close to the NAV. Now, I've lied to you a little. You and I can't do the in-kind purchases and redemptions, but there is a market specialist who can. So if the deviations get too big, then they will take advantage of the arbitrage, and they're actually incentivized to do it. It's not like it's an evil thing, because if the values go up, well, what we want them doing is buying shares, and we want them to buy the shares and sell the individual securities, because that drives up share price, drives down security price, and pushes the prices closer together, and just the opposite if the prices drop, right? So we want this process of arbitrage to keep the NAV close to the net, keep the selling price close to the NAV. And it's the market makers who are charged with doing this, and in fact incentivized to, and it's good for everybody because it keeps the actual price close to the net asset value, which is what we want, because we buy these funds for particular exposure. We want something in particular when we buy these funds. We want exposure to the Indonesian market, right? Indonesian equities. Well, if you let the values drift from the NAV, what happens is the correlation between the Indonesian securities and the US securities, which is normally low, well, you let that become dominated by the US stock market, and the correlations increase, so you lose some diversification benefits if you don't have this property in place. All right? So I think ETFs, very efficient, very low cost, and I think ultimately are going to they're already big. I think they're going to be bigger going forward. Okay, so separately managed accounts. These are just, this is a terrible name. Separately managed account. It sounds like a lot more than it is. It's just an account that's owned by a single investor, right? There's no mutual fund because there's no mutual, right? The mutual means you and I own it together. There's a single investor. They're sometimes called wrap accounts as well. And typically they're going to have some fairly high minimum investment. Here it lists $100,000 to $500,000 as the minimum to get a separately managed account. I'm sure there are places you can get separately managed accounts with that amount of money, but well, let's put it this way, it ain't at Goldman Wealth Management, all right? So this is way, way too small for for what people think of as separately managed accounts. Typically, it would be minimum investment a lot larger than that, all right? Let's see, so other types of pooled investments, a buyout fund. So we're going to pool some money here, probably in the form of a limited partnership, and we're going to buy all the public shares of a company, and we're going to take the company private. It's called a going private transaction. It's typically called an LBO, right? So L is for levered, so levered buyout or leveraged buyout. So a leveraged buyout firm means that we're going to use lots of leverage. Leverage is code for debt in finance. So we're going to use lots of debt or really high leverage. There's two ways to say the same thing. So we're going to put in a couple of $1 billion. We're going to borrow, $15 billion, and we're going to go out and we're going to pay $17 or $18 billion, buy all the shares of a company and take it private. And what we're hoping to do, this company that we're buying is obviously not perfect. Okay, so we're trying to buy one that has some fundamental flaws that we can fix, right? And we're going to fix those, and we're going to increase profitability, increase cash flows. We're also going to hopefully drive up the growth rate, and then we're going to take it public again. So we take it private, we fix the firm, and then we take it public again, hopefully for a very large profit. So that's what LBO firms do. So this would be a type of private equity investment. The typical other type of private equity would be a VC fund. So a VC fund, of course, venture capital is providing startup or early stage financing. So you're investing in a company that's still in some woman's garage and she's got some new technology or app thing she's creating. So it's very early stage. You expect to have significant numbers of failures. So if you think, okay, I'm going to have a VC fund, I'm going to buy 10 companies. Well, 2, 3, 4 of those are going to be complete losses. 2, 3, 4 of them are going to have, returns of from 0 to 100%. Of course, 0 is a lot better than minus 100, right? 0 to 100%. But you're going to have 1 or 2 up there that are going to be, home run, grand slam type things. And I forget the number, but so one of the early VC investors in Google invested a few $1 million. I forget what it was. Maybe it was 10 million, but brought home like $1 billion at the IPO or something. So, the payoffs can be extraordinary, right? Anyway, so it's the success. It is a few big successes that drive the returns for the whole fund. So you expect some failures, some modest type things, and then a couple of home runs. That's what drives the returns in the VC market. So active, and you're going to think that, or if you're a VC, You're going to have active management of the portfolio companies. That means that it's not like a paper investment. You're not a mutual fund that buys a few thousand shares of stock in Microsoft or in GM or whatever it happens to be. You're going to have a seat on the board, or someone on your firm is going to have a seat on the board, and you're going to, talk actively with production managers and research scientists and that type of thing. So there's a much more active involvement between the providers of capital and the management of the enterprise when we're talking about a VC portfolio company. Okay, hedge funds. Hedge funds, these are investment pools of money that are not registered to offer shares to the public, right? They can sell they have to sell to a small number of accredited investors. Accreditation typically means that you have lots of money, so you've got some minimum financial requirements that you have to meet. So typically, to get into one of these, at least a good one, there's going to be a high minimum investment. You can't get in with $127. They're going to use, at least at times, a lot of leverage, and they're going to access derivatives when they need to. And there's as many strategies as you can think of for hedge funds. So you can have a long short, that is, combine a long position and a short position in the same industry. One you think is going to go up, one you think is going to go down, that type of stuff. You can have global macro, looking at currency changes. You can have event driven, you name it. Okay, then you can have it working for you in a hedge fund somewhere. And of course, across the quality dimension, good hedge funds are really willing to pay for top analysts. So they do well. They don't have to report their results, so they can be really nimble. But there's also a quality spectrum here because everybody wants to call themselves a hedge fund, so you have to be a little careful about that. So that's our introduction to portfolio management here in terms of the types of assets that we can put into our portfolio, the IPS, the way we're going to think about it, that is the portfolio perspective. But there's still a lot of detail that we have to get through in terms of the fundamental relationships between securities, the notion of risk management, and those types of things in order to have a good introduction to portfolio management as a topic. And that's why there's more than one reading in this study session.